Well, thanks everybody for joining again, taking some time out of your evening to learn a little bit about real estate and getting a chance to network with some other crazy Toronto real estate investors. So all I see is a black screen right now. There we go. There's our presentation. Time for a new laptop. Okay, next slide, please. Who are we exactly? In case you're new, I know we have a lot of people who are returning. And in case those that don't know, my name is Ming. The other gentleman speaking just now, his name is Matt. And we are the front men for Volition. You hear us talking at the meetups and things like that. But what are we exactly? The purpose of our company is to help people navigate the world of real estate investing. It is a complex place, and I really wish something like Volition existed when I was starting out my real estate investment journey. I didn't know much, and I did a lot of things incorrectly and inefficiently when I first started out. We also try to be a complete provider of solutions. So if you need lawyers, architects, engineers, whatever happens to be, if you're a client, we help you from A to Z, get you from building a plan that matches your investment model, matches your goals, to getting to a point where you're rented out, right? So beginning to end. And then the third thing that Matt alluded to at the beginning was we not only have cutting edge research, but we synthesize it. We take that research and turn it into a business model. It's nice to know that, oh, this is going to be the latest Toronto neighborhood, but what do I do with that, right? And that's kind of the next step that we'd like to take things to at Volition. Next slide, please. So who are we exactly? We are first and foremost real estate investors ourselves. We won a bunch of awards around it, been featured in a bunch of publications, and spoken at a bunch of events. This is, as I was saying, not to impress you, but impress upon you that we know what we're doing. We're investors ourselves, first and foremost. Next slide, please. So what does Volition do exactly? Because I get asked this question all the time, like, how do I work with you guys? If, sounds interesting. These are the four things we do. So first thing is advisory. We teach, educate, provide consultation on real estate investing. And tonight is an example of advisory. We teach people about, Cherry will be teaching people about, but we bring people in to teach about the various areas of real estate. The next thing is realty, and this is really where you would be working with Volition. You're looking for an investment property, finding one that fits your particular business model that helps you hit your goals. It is a very non-trivial task to find the right type of investment property. Next thing is renovations, because once you get that property, you likely have to do some sort of renovations on it, or you may have to do some major work to have it hit your business model. We do that. And lastly is leasing and property management. Once you've got this beautiful property, you want to get it rented out, we can take that on for you. Investor agents make the best normal agents. I put this slide back in because when I look back at 2021 so far, almost 50% of our business has been regular work for a whole bunch of reasons. The same analytical approach we take to investing, we take to finding your dream home, or finding a home that meets your school requirements, meets your construction budgets, whatever it happens to be that your constraints are. We apply that same sort of analytics to your regular home search. Construction. Oftentimes, if you're buying a house, you need to find a place that you might be finding a place that maybe you want to do the kitchen, maybe you want to underpin the basement. Because we have a construction division, we're able to advise you on the kind of effort it would take to do construction at a particular property. If you're looking for a secondary suite, or you want to build a laneway house, or you're going to use your primary residence as part of a more advanced investment portfolio where you're going to draw funds from a HELOC or have rents count towards mortgage qualification, we can definitely help with that. And also, does the house that you're buying, that you're living in, hold up to appreciation fundamentals? Are you buying in a place where, in 10 years from now, it's not going to be worth much more, or you buying in a, in a hot Toronto neighborhood where in 10 years from now, you'll see good lift on it. So anyway, like I said, the same approach that we take to regular, to our investor side, we apply it in a personal residence context. Next slide, please.
Something I just want to add quickly. So definitely, homeowners can benefit from our services. Home sellers as well. There's so many instances in which we're able to step into a place, understand how to get the maximum dollar for this, and that can often mean, especially in a market like this, where it's really hard to find contractors, and if you for example, if you spend 25K redoing that kitchen, we have the analytics and the vertical integration through their entire organization to do that renovation for you, so that you can get an extra 75K out of your sale price. Just as an example, we've done that time and time again, and being able to add value and being able to manage that entire process for you is an extreme value add. Okay.
Yeah, that's a great point. In a hot market, people say homes sell themselves, and yeah, a home will sell itself. But if you want top dollar, that's a different thing. That's a different ask.
Yeah. Oh, okay. Here, I'll talk about this one. So sure. As of 6:30 p.m. last night, Volition was featured on HGTV. We got featured in an article where we contributed to an article that was entitled "Expert Tips That Will Help You Become a Homeowner Before 40." It was quite the fluff piece, actually.
Actually, before you shoot it down, I think it was actually a more realistic approach to how to actually become a homeowner, instead of frankly crappy tips that are often given.
Instead of don't spend more than you earn, or don't spend more when you get a raise, or don't buy that avocado.
Don't buy coffee, expensive coffee or whatever.
That doesn't really move the needle. So, but yes, we contributed to this article. Actually, we wrote the entire damn article. They just proofread it and edited it. But anyway, that's besides the point. So there's a link here. Shelby, if you don't mind dropping that into the chat, you guys can go check it out.
Already done.
Oh, she's so on the ball. And yeah, so if nothing else, there's a bunch of pretty pictures in it. But anyway, definitely, we think that there's some good stuff. We did have to cater the article to the audience. And this is an audience who loves stuff like, here are 5 cities that you could still buy a house for 500,000, right? Like that's the type of audience, or like, what's the other one I saw? Like, 5 top 7 tips to ask your realtor when buying a house. So anyway, that's the kind of stuff that they love. So we had to cater it to them. So, but hopefully there is still some good stuff there. But if you want the real thing, come and talk to us directly, and we'll give you some better stuff than what we had to put together for HGTV. But yeah, we're up there. So go take a look.
And a couple of team updates. So, Ed is, not sure if you heard, but Ed has moved on. He's, I like to say, a true entrepreneur at heart. So he's been pursuing other business opportunities, and no doubt they're going to be successful. He has to spend a little more time on those businesses, and unfortunately for us, a little less time with us. But just wanted to thank him so much for his hard work and time with Volition.
Yeah, absolutely. But not it's not all bad news. At the exact, what's that saying? When someone closes a door, God opens a window. Anyway.
Great saying, Matt.
Chris showed up on our doorstep. He didn't really show up on our doorstep. Chris has been a long time Volition client and advocate. And you probably recognize Chris. He's at every meetup. He used to be one of our meetup greeters when we were in person. Are we allowed to say that? Greeters? Meetup greeters?
I guess so. I don't think Walmart has a trade on it.
Okay, anyway.
Yeah, ambassadors is
ambassador. Ambassador, that's the word. Okay, so he was one of our ambassadors. And he's been on stage sharing his story with the Volition audience. even as recent as our recent masterclass, which was January, February of 2021. But yes, he's come on, he's joined the dark side. And just to tell you a little bit about Chris, yeah, he started coming to this meetup when we were like 8 people in a Buddhist temple somewhere, right? And Buddhist temple turned event space. Chris took, he took massive action, overcame a lot of adversity, and has significantly grown his portfolio and is well on his way to achieving his beliefs. So he's going to be wearing a couple of different hats. He's going to be your investor realtor. He's going to be one of your real estate investment advisors, and he'll help you with your leasing. So Chris, do you want to say hi?
Yeah, thank you so much, Matt. And it's just an honor to be joining such a, high-performing, cohesive team already. And I'm super excited to be joining. Just hoping to be humble and share my knowledge with anyone who's willing to listen. And yeah, I'm just super excited to be here. So thanks for the introductions, and hello, everyone.
Well, Chris is one of the nicest guys you're ever going to meet. So, I'm sure you're going to cross paths with him soon. Thanks, Chris. All right. Now let's get back to work now, Chris. No. Yeah, so our team, we did shoulder a significant loss with, Ed was a significant contributor to Volition, but Chris is here to pick up the slack. And so this is our team. Temporarily, we were short-staffed, but we are back up to capacity now. So there we go.
I just realized that 5 of 9 are former Volition clients. So if you want to work at Volition, I mean, just buy a house with us first.
That's the criteria.
Yeah.
No, for sure.
Cool. Next slide. And I mentioned before, we have our mission statement, and this is like our mission image. We really want to be that eraser in your life to break through the investing maze that is out there. So we like to show that because this is what we aspire to be. Just a reminder, any clients that we have, just if we missed you, please let me know. Oh, actually, please let Shelby know so you can join the private mastermind chat group. We talk about investing. We talk about everything. We're a bunch of crazies who are really passionate about this stuff, and a great safe space to share life as a landlord.
There's a few people on here who keep everyone else up to date on the real estate market. Interest rates, the mortgage qualification rules. If you want to stay up to date and you want a curated list of things, this is the place to be. It is exclusive to Volition clients only. Oh, Shelby, I thought you were going to put a screenshot up here. Couldn't find one. We were gonna
coming next month. Stay tuned.
Yeah. Okay. We were gonna do a screenshot to show you some of the stuff that we talk about. But anyway,
we'll be talking actually about one of the articles that came up a little later on tonight.
Okay. There you go.
Cool. And then just a reminder, if you are interested in investing in real estate and you want to get started, you're not too sure where to go, or you're already an experienced investor, you want to figure out how to take it to the next step, send us a note. We provide a complimentary advisory session. You can send it to info@volitionprop.com, and we can schedule you for some time together.
Actually, even better, Shelby, not email.
Oh, there's the link.
The link's in the chat.
Link in the chat.
Okay.
Matt doesn't read the chat.
Actually, I'm presenting. I can't see. That's why. But yes, this is your first step. Most people don't know what the first step is. They don't know what to do. What I'd say is don't go call Uncle Joe the realtor. That's not your first step. Okay. Don't start there. That's the wrong first step. Start out on the right foot. Have a chat with us, and we'll see if we have an opportunity to work together. A large part of what we do during the advisory is helping you figure out where you're at right now, helping you figure out where you want to go, and then most importantly, figure out a plan to get there. And so through advisory, you'll get a sampling. This is going to be a complimentary advisory session. You'll get a sampling or an idea of what it's like to work with us before we kind of dive in and take the next step together. But the first thing you do is click that link that Shelby just put in the chat. And is it a Google form? Is that what it is?
It is.
Okay, so fill out that Google form, and then that's your first step in getting something scheduled with us. Okay, good.
Great. So into the market minute. For those who are new, every month we like to dive through all the latest details to see, what the impacts, what's happening in the market, and then dive into that data a little further. So we start with sales volume, and obviously no surprise to those who have been attuned to the market. We are also, and I'd say once the May numbers come in, we'll start to see a further decline in sales volume is what I'm anticipating. But spring market basically came pretty early this year. From January, February, it was on a tear. March, we peaked. And now we're starting to see a bit of a slowdown in the market. Definitely not a slow market, but a bit of a slowdown. So offer nights are getting more like, 3 to 5 offers, as opposed to, in January, February, I was seeing 30, 40 offers on offer night. Part of this is, the prices have risen sharply during this time, and they're starting to level off in terms of pricing. People were in a rush to buy before mortgage qualification rules came into effect. And there's also some buyer fatigue. Like a bunch of the clients, especially, I'd say, unfortunately, my clients who are on the home buyer side, it has been just a rough ride. Like every couple of weeks, we're out looking at properties a couple of times a week, and it's been really tough to get in and to find good properties. The next slide, please. So this is the one that's made headlines everywhere, and I'm really excited to talk about this. So if you look, April's average resale home price is down. So that must mean like homes are cheaper, right? Actually, it's completely wrong. I will show you later on how we can have this be correct as an April price is down, and have other charts that show condo prices up, detached home prices up, across the board prices are up. But for both charts to be accurate, they just tell different stories. So let's keep going. Next one here, we've got new listings. And so as I mentioned, spring came early this year, so we see the peak in listings happening in March. This is always interesting because we want to know how much inventory is available on the market. But if we go to what's more interesting is the next slide, which is we take a ratio of the sales against new listings. Somebody pointed out to me that I never really explained this slide. I just kind of show it and talk to it, but I don't tell you really what sales to new listings ratio means and is. So this is a ratio of sales against new listings, and new listings are listings that are 30 days old. So a high ratio, for example, means that the inventory that's out there at the price it's at is being accepted by the market. So a high sales to new listing ratio tells me that the market is happy at buying at the prices people are asking. It doesn't tell me what those prices are exactly, but if I go now back and look at average sale price and I see that trending up, I know that the market is fine with fast trending prices. Sales to new listing ratio, when it's low, that means basically people aren't buying aren't buying houses at the price that they're set at with the inventory that's available. So either people are asking too much for their homes, or the inventory out there is not very good. That is generally an indicator then, if I see prices, let's say, flattening, that the market is going to come to some sort of stabilization. So the reason we talk about sales to new listing ratio is it tends to be a slight leading indicator as to what's going to happen in the market, with some, it's not super accurate, but it generally kind of tells you what's going to be happening in the next couple of months. So if we go to the next slide, on our mastermind chat, I think it was Jason on our mastermind chat sent out an article from Better Dwelling. And I usually hate articles in Better Dwelling because they're like a doomsday publication. Every headline is like the world's going to end. But this one was about the sales to new listing ratio, which obviously I like because I talk about it all the time. And I was like, oh, awesome. Maybe there's going to be some data here. So I looked into it and I was like, oh, great. But this is kind of the point of the sales to new listings ratio information. There wasn't anything new. But basically what this chart that they published shows is they're showing the change in the SNLR against price growth. And this is really key because if you read the article, it makes it sound like every time sales to new listing ratio is trending downwards, housing prices go down, which is absolutely not correct. There's one sentence in there and it says price growth, and I'm going to underline and bold the word growth because what it actually means is as the sales to new listing ratio drops month over month, the growth, so as the speed of increase of prices slows down. So I'm not actually seeing a decrease in price. I'm just not seeing it go 10%. I'm seeing it drop down to like 2%, right? So the curve starts to flatten, which is exactly what I expect to see. We've had phenomenal, price growth in the last 3 to 4 months. That is never sustainable. It will flatten off, right? So what we're seeing here is a historical chart of every time the SNLR drops, you'll see the black line just after that, which is the year-over-year price increase, slow down, right? And that's shown twice historically here. We're showing another, I think we've had about 4 or 5 months now of SNLR decreases. So I do expect, pricing to start to slow down again. What does that mean for us as investors? It means the next couple of months are going to be a great time to buy. We won't, hopefully, be fighting against as many people. It doesn't mean that our pricing is going to be much better, but it means we'll have less competition on good assets. And that's really what's going to make a difference for us in our investment portfolios. Any questions about that before we jump to the next section? No, awesome. Next section then.
That either means people are asleep, or you explained it so well that it's one or the other.
Yeah. Oh, I see something here. Is there seasonality?
Someone asked you a question?
Yeah. Is there seasonality sales to new listings period that is stronger to list a home? Yes. There is. So that's not the indicator I would use as to when to list your home. What I would use is actually based on the demand side. So the best time to list your home is for the spring market. So that means you've already missed it, but the next best time would be the fall market. And the reason is what drives people to buy primarily is to sync up their purchase with start of school season. Parents want to get into their house and settle down before September starts, which often means buying a home within kind of that March, April, May timeframe and having it close before September. Flipping, same thing. The ideal flips exit in the spring market, right? So depending on the exit of your investment or you're just listing a property, it's kind of the same thing. You want to get into as many potential buyers as possible. So anyway, that's kind of my advice. And I wouldn't be looking at ratios for that. It's the buyer pool in that case.
You should also, like, if your property is in Toronto, let's have a chat because these are macroeconomics, right?
Yeah.
But any one particular property might buck this trend. The property you're talking about still, like, it may not matter. There still might be there's a generally a best time, but for your particular property, it still may not make a difference. So,
and that's an excellent point, because if you have like a multiplex or something that falls outside of the mold of a single family home, then actually those things I just talked about don't apply. So
yeah, exactly. But anyway, that's where you need sort of good advice, right? Investor realtor advice. Okay, let's go.
Next slide. So now we dive into the Volition metrics, and for those who are new, we track what's called the home price index, which looks at like for like properties, month by month, neighborhood by neighborhood. So we look at, for example, a single family home, 3-bedroom, single family home in the same neighborhood, and how do those single family homes compare every month. We're not looking at an average, we're not looking at a mean or median or any of these other kind of bits of data, because that doesn't tell me how my 2-bedroom condo is doing month after month after month. So if you go to the next slide, Matt, when you're done your beer there.
Priorities.
I don't want to disturb you, sir. So if you look here, downtown single family detached has been on a tear, continues to be on a tear, and as I mentioned, earlier in the presentation tonight, we are starting to see a bit of a gentling of the curve when it comes to detached home prices. And I would expect to see a continued gentling of the curve over the next couple of months. Flip over to condos, which is the next slide. Condos continue to be on a tear. Since the beginning of the year, they've been up. They will continue to be up. I don't see, anecdotally, I don't see much of a slowdown in the market. It has continued to be quite hot in condos. So I'm expecting May to continue this trend. So how is it? If you remember earlier, we had a slide that showed price down in Toronto. Well, and these are showing price up everywhere in Toronto. So what is happening is the first one is an average, and what is not accounted for is volume. So we are seeing more volume in condos right now. There's more transactions happening in the condo space, which brings down the average price. So because condos have been so hot, there's been such a tear in the condo market, the average home sale price is lower because it is mixed between condos and $10 million homes. But actual prices of those assets hasn't changed. They've just gone up and up and up. There has been no discount in pricing. So anybody who's thinking, oh, prices are down, it's not actually a reality. There's a quick question asking what's the downtown single family area. If you go back 2 slides. This is the downtown. So basically we're using the TREB neighborhoods and we're going like TREB neighborhood by neighborhood. And that's what those charts are showing.
So specifically, if you're familiar with downtown, this is downtown core, Annex is here, High Park is over here. This is, Little Italy, this is Trinity Bellwoods over here, Dovercourt Wallace Emerson, and on the east side, you've got East York, Plater Estates, North Riverdale, South Riverdale, Riverside, Leslieville, Beaches, just to give you an idea of what we consider the downtown single family home market. Is that cool?
Cool. So keep going. So then we also look at everywhere else and how it's doing. Next slide, please. And that upward trend that we've seen, kind of that lift happening quickly since January, is continuing even outside the downtown core. So up into the CO7, C14. So that's North York, east and west of Yonge, into the boondogs of Aurora and Stouffville. Those markets are recovering, and they've been fast for those markets as well. As I mentioned, half of the work we do is single family residents. That happens to be in places like King City, Vaughan, Aurora, Richmond Hill. We do personal residence in those areas. We don't advise you invest in those areas, but if you're looking to buy a single family home, we do work in those areas. And we are seeing competition, not as crazy as downtown Toronto, but properties are selling fast. Some of them going on Bully, and usually a couple of offers an offer night.
Yeah, there's actually a chance right now you can be neighbors with Ming.
Oh, it's sold on Bully.
Oh,
2 days, 150,000 over asking.
Okay, oh, that's too bad. You could have been your properties could have backed onto each other. You could just remove the fence, and you guys can sit there and talk real estate all night.
It's funny. My wife sent Matt's wife, and Matt's wife sent my wife neighboring listings. So both wives are trying to talk the other into becoming neighbors.
Yeah, you could have been my neighbor too.
Yeah.
All right.
Cool. Next slide, please. Awesome. Case
Do
study.
you want to do this,
So,
or do you want me to do it?
I'm actually going to drop off now.
Okay.
I have to take care of Sina.
Okay. Yeah. So.
Okay.
Okay. Thanks, Ming.
Thanks. If anybody has any questions for me, feel free to reach out to me at info@volitionprop.com. Thanks very much, everybody.
Cool. Good stuff. All right. So we're doing a case study tonight, and this one's going to be interesting. So this one is a triplex conversion plus a laneway. Big project. Be good for example, if you were an architect named Edward. But this area, so it's a single family home that's was purchased in Dovercourt Wallace Emerson. Junction now. They tacked on Junction, so they renamed the area. It's in an area that we love. We personally own properties in that area. A ton of our clients own properties in these areas. Funny enough, we have clients who own on Dovercourt and Wallace and Emerson. Well, there you go. So the strategy for this is a buy, rent, or rent refi. So it's a midterm family hold. I think this particular individual has partners, so I think that's why there is an exit in mind right from the get-go. So for the main house, we're planning, or he's planning, our client is planning, 3 2-bedroom, 1-bath units, and he's planning a big laneway house as well, a laneway suite. It's a 2-story, 1,400 square foot, 3-bed, 2-bath. Think about how big that is. A lot of normal houses aren't even that big. A lot of the normal houses are 1,200 square feet. So this is crazy. So laneway housing is a massive trend in Toronto right now. Are we talking about it in a meetup this year? I can't remember. But I think we are, Flo?
We are.
Okay, thank you for keeping me honest. And in fact, we have an HGTV article that's coming out, I don't know, in the next month or so about laneway housing, talking about kind of the ins and outs and what to look for in laneway housing. So if you're looking for a new housing trend, so next month we're going to be talking about Toronto's new hottest neighborhood. We're looking at the new housing trend. Laneway housing is the trend. Cool. Any questions about the property so far before I get into some of the financials? Does everyone know what we're trying to achieve here? So buying an older home still looks pretty good actually. But anyway, you're gonna probably gut it and make it turn into three luxury legal units. No questions? All right. Laneway. So can I build a laneway suite? It depends. Sort of like when you ask an accountant, oh, should I incorporate? The answer is, it depends. So just because you have a laneway does not mean you can just build a laneway house. There's some high level criteria, we call it conformance criteria, as to whether or not you can actually build, right? So the best thing to do is actually to get a consultation. Well, actually, the best thing to do is to work with an investor-focused realtor who knows the ins and outs. But the second best thing to do is get a consultation and actually figure out whether or not you can build something here. So yeah, so the output of a consultation sort of looks something like this. And check. Yeah, okay, good. We can go build a laneway house. So this particular property did have a deep enough. There are certain things you're going to look for. And especially, this is where it's super important to have an investor eye, an investor-focused realtor, because we're always looking for highest and best use. We're looking for underutilized properties that we could put underutilized properties where they haven't yet developed into their highest and best use. It's underutilized potential. So something like this, we're looking for things like, we know as investor-focused realtors, what the optimal size of the lot needs to be, for example, in order to maximize the size of the laneway, right? Does it make sense to buy a smaller lot that has a laneway? Well, maybe that only gives you, I don't know, a 600 square foot or 700 square foot laneway house over 2 levels. Does that make sense? I don't know, right? This is why it's important to work with someone who actually knows, so that when you're going through the offer process, you can have the confidence that you can build what you're intending to build in order to meet your business model. So anything you want to add, Flo?
No, I think you have a good overview. So I think one thing Matt pointed out that's really important is that there are a lot of requirements. And so just because you see in a listing that it says it's laneway eligible, there's due diligence that's actually required. And one of the things we look at from an investment perspective is whether the size of the laneway suite justifies the economics of an investment.
Absolutely, absolutely. There are so many freaking things to look out for, side setbacks and just, access. There's so many things. And especially when you're trying to tack this on to another business model. So a laneway is really a tack on kind of an independent business model that can be tacked on to something like a triplex. But you guys start thinking about the triplex. Like for something like this, for example, there's access through the laneway right now to enter the back of the house. What does that look like once you build up the laneway, right? So there can be even a strategic conversation that you need to have around, should I develop the main house first? Should I develop the laneway first? There's a whole bunch of stuff to think about. And so you really need to have really deep conversations with someone who knows what they're talking about so that this business model runs successfully for you. Cool? Okay. All right, let's go through some financials of the case study. So purchase price for this is an actual property. Our client purchased it, I don't know, a couple weeks ago, 3 weeks ago, 4 weeks ago. Hello?
Something like that.
Okay.
in recent history, how's that?
recent history. Okay, so the purchase price for this property, I think it was listed for 999.
No, 1099.
1099. Thanks,
Yep.
Sam. And then sold. Oh my God, it sold for 300 over ask. Shut up, stupid realtors. Anyway, sold for 1388. The initial investment, 20% down payment plus closing costs, was about 330. No rent, so single family home. Okay, holding costs. So a project like this is not for the faint of heart. You should not embark on this unless you have significant reserves and it's a very daunting process. You just have to be well prepared for it. Have a conversation with someone on the Volition team. Talk to Flo. Flo has been through it. She's been through it. She's going through another one right now. So Flo has very deep pockets and very big kahunas. So So this is at least a 12 to 16 month project. We modeled this out at about 16 months because we know what it entails. There's a lot of things, and especially given the current state of Toronto and the planning department, COA, permits, it's very, very slow right now. So you need to model on the conservative side and expect at least 12 months, and we recommend having reserves for 16 months, which means you have to have your holding costs. That's a significant amount of time without any rent coming in, right? So this is a holding costs here are your hard expenses, which is your property tax, insurance, hydro, gas, water, plus your mortgage payments for that duration. Cost of the reno. The renovation for the house, for the main house, is about $450, and the quote that we were getting for the laneway house, it's a significant sized laneway house. So this is a little more expensive because it's 1,400 square feet. You can definitely, in smaller laneway houses, we've seen quotes in around the 350 mark, stuff like that. But it is, when you have more square footage and when you're building up that second story, those costs tend to rise. So this laneway house is about $490, which means your total rental cost is about $940. Total cash invested is about $1.35 million. Okay? It's a very, it's a good chunk of change, no doubt. So, this business model is not for everyone. It's for people who have capital laying around that they want to put to good use. ARV, so after repaired value. After the renos, the main house is going to be just by itself, is worth about $2 million, right? The laneway. So I know it's strange for us to separate this out, but we kind of had to do this. The laneway by itself, we estimate, this is an assumption. This is not based in fact. The reason it's not based in fact is because there's no comparables out there. Laneway housing is such a new initiative that there are no good examples out there. So normally, how is real estate valued? It's valued when, that house down the street sold for $1 million, so mine's worth about $1 million, right? Oh, okay, my kitchen's a bit nicer. Okay, mine's worth 1.025, right? Something like that. Laneway houses aren't like that right now. And in fact, it's so new, banks don't even know what to do with them. Banks are so far removed. They've got their thumbs up their asses right now and have no idea how to value these. They have no idea how to treat the rental income from these. Sometimes when you get appraisals, even though there's a laneway house there, they'll just go, okay, we're going to pretend that that's not even there. And then we're just going to do the appraisal for the main house. It's like, dude, this laneway house is worth $600,000, $700,000. How can you just disregard it like that? But that's just the state of the lending industry right now. Even the best mortgage brokers still haven't yet figured it out with their lender partners. That's how new this is. All to say that this valuation then for a laneway is based, our estimation or valuation is then based on a cap rate. It's based on an income perspective. So I'm going to jump ahead very quickly. We think that a laneway with a 3-bedroom, 2-bath can rent for at least $3,000 even in today's environment. So if we were to take $3,000, here, let me, I'm going to use my iPad and make. Okay, can everyone see my screen?
I'm laughing at Matt's whiteboard. Oh my gosh.
I love whiteboarding. Makes me feel like a teacher. Okay. Oops. Okay, let's try this again. Okay, so let's say rent is $3,000, right? Let's just say about 15% of that goes to his expenses. So I think when I did the math, that's about $450, which means $2,550 is your net operating income monthly. So here, someone help me out. What's 2,550 times 12 to annualize it? See Chris doing it.
30-some thousand.
Come on, Chris.
30,600.
30,600. Okay. So this is your NOI annual. So just in case you want to know, net operating income is basically rents minus expenses, and you're left with your net operating income. Okay. So here, instead of me just telling you, let me ask you. I'm going to pose this out there to everyone. What's the cap rate in Toronto? What's a generally good accepted cap rate in Toronto residential? Daniel Wang, 4%. Ida, 3%. Who else do we got? 2%. Cherry, that's aggressive. 3%. So generally speaking, a good Toronto is about 4.25, about 4.5, somewhere in that range. It can occasionally dip below 4, which is 3.75. So just to give you an idea, 3 is probably a little too aggressive. 3.25 is probably Vancouver type of territory. Okay. For the purposes of modeling, I'm going to model this at 5%, which means, Chris, can you help me again? Take 30,600 divided by 5%. What do you get? Come on, Chris. There you go. Thanks, John. 612,000. So how did Matt come up with? Here, let me go back now. No, that's not it. There. Oh no, that's the okay. There. How did Matt come up with a valuation of 600,000? Was it pulled out of my ass? No, it's based on an income approach, cap rate. There's also a couple of different ways you could do it. You could do it on DCR. You could do this. You could do this on a couple of different ways. You cannot do it on comparables. So that's my point. Okay. So if generally speaking, put these two together, 2.6 million is the ARV. Over the course of 16 months at 5% growth, so Toronto has been averaging anywhere from 7 to 10%. We normally model things at 5%. To be conservative, modeling today at 3%, that means in 16 months, this property is going to be worth 2.74. Okay. So equity takeout. So this is always a tough conversation, a tough discussion, because this is highly, highly, highly dependent on you. This is not to do with the business model. This is to do with you. Can you qualify for a big, new, massive mortgage? In this case, we're assuming that this investor can qualify for a full 80% loan to value mortgage on the new valuation, which is 2.74. This is also assuming that the banks get their shit together in 16 months and know how to value properties with laneways properly. Okay, so let's assume this valuation. Let's assume that he can get 80% loan to value mortgage. It may not be 80 for you if you do it, maybe 75, maybe 70, but for the purposes of modeling, I'm just going to show you 80%. You minus the old mortgage, which means you have a $1.119 million equity takeout. You minus your new equity takeout versus from your total cash invested, which means your net investment in a property like this is $230,000. $230,000 for a $2.7 million triplex plus laneway. And the beauty of this is with the rents where they're going to be 2-bedroom, 1-bath, 2-bedroom, 1-bath, 2-bedroom, 1-bath, and then 3-bedroom, 2-bath, almost 10 grand in rents, minus your expenses and minus your mortgage, still cash flows about $1,000, even after you took out a $1.1 million equity takeout. What do you think?
It's a great investment.
Oh, have I convinced you, Sam?
Totally.
Are you ready to take action, Sam?
You need to kind of size some capital first.
Anyway, I wanted to just give you a sense, like this is literally what our client is doing. He just purchased it. This is his plan. These are not fictitious. This is not a fictitious property. This is a real investor with deep pockets, or at least partners with deep pockets, and he's embarking on exactly this. Cool. Okay, so then let's look at it on a 5-year basis. So 5 years, assuming this is 5 years after the reno, by the way, it's just for clarification. So if you hold this thing for 5 years, assuming an escalation of rents at 3% and inflation of expenses at 2%, it's $92,000 of positive cash flow over 5 years. There's $290,000 of mortgage pay down. Oh, sorry, let me go back. $92,000 of positive cash flow over 5 years, which equates to about a 3.1% annualized ROI. Annualized ROI based on the $230,000 net investment. Sorry, the $230,000 net investment blended on a time-weighted average with the $1.35 million initial investment. That's how you get this annualized ROI. 5-year mortgage paydown is $290,000, which is an 8.9% annualized ROI. The initial reno equity lift is a 6% annualized ROI. It increased the property value by $177,000. 5-year appreciation at 3% is another $733,000, which is another 24.8% annualized ROI. Total, it's about $1.3 million return and an annualized return of almost 44%. There you go. Any questions? Well, it's this is one of those business models, one of those examples where we say, bigger money, yes, but bigger reward, right? So Toronto is very, very, very tough to invest in, and so trying to do what you can do in other cities, smaller city centers, your Sudburys and Windsors and stuff like that. Those models often don't work in Toronto. You have to be more creative. You have to think more creatively. You have to put properties to highest and best use. You have to densify. You have to change of use. That's how you're going to invest in Toronto. Just hoping that you're going to buy something and hoping that it's going to work out in cash flow and stuff. They do exist, but they're very, very far and few between. Okay. Okay, so if you don't have any questions, I think we're going on to the main event. What time is it? Okay, 7:50. Not too bad.
Now we're just going to quickly launch the poll.
Oh, okay. Okay, let's go back. Let's go back then. Okay, go ahead, Shelby. What's the poll say?
There you go. It's live.
Oh, okay. So I think we want to, it's sort of like a, let's get to know you a little bit. So I've already completed a project like this. Ooh, curious who those people are. I'm ready to take action on business model now. Well, if you got 1.35 million, let's have a chat. I'd like to learn more about this business model. Yeah, come, reach out to Volition, that Google Forms link that Shelby dropped in the chat, and yeah, we'll talk about it. Or I'm looking for a stepping stone approach to eventually get to this business model. We can definitely help you there too. A lot of what we do, the reality is no one reaches into their couch cushions and finds 1.35 million, right? That's just the reality. The reality is people start off with smaller assets and they will grow over time. They'll build equity over time. They will refinance those assets. Maybe they'll just dispose of those assets or divest those assets and get into better assets. That is the stepping stone approach, right? I think we even talk about it in our HGTV article. So I guess it's not all fluff in there. Okay, are we done the poll?
Yep.
Thank you all. That's very cool. What were the results? Do we have the results? Can people see the results? How does it work? Shelby, do you know?
Stepping stone
Oh, you're cutting out.
approach.
Okay. Oh, there we go. Cool. Very good. Very good. Thank you. Thank you for that. Cool. All right. So now we're going to get to our main events. So, Cherry Chan. So what needs to be said about Cherry Chan? Cherry Chan is one of the top real estate investment accountants in Canada. We've done a lot of work with Cherry's husband. Cherry Chan is one half of a power couple, and her husband is Erwin Cito. Erwin Cito, formerly known as Mr. Hamilton. I think he's into a lot of very, very interesting things now, including iWin and Infinity Wealth and Stock Hacker Academy. And Cherry, on her own right, runs a very successful accounting practice, and she's one of the top tax advisors for real estate investors in Canada. We've followed Cherry for a very long time. I think we do a lot with Cherry's husband Erwin. Cherry's a behemoth in this industry. She's given so many presentations, even for big organizations, for Rico and Shred, and advising even real estate agents on how to best structure their own taxes and assets. So, but anyway, without further ado, I'd like to pass this over to Cherry Chan. So welcome, Cherry.
Hi everyone. I am. Can everyone hear me clearly?
Yes.
Yep.
Yes. Okay. All right. That's good because I'm not really sure. I don't do this very often at home. So thank you so much for the introduction. It's an honor to be invited here as always. I'm not nearly as cool as my husband, John. So I know that I'm not super cool like him. And but it's okay. Accounting and tax is not supposed to be sexy. So I'll just try to make it slightly more fun. Let me see if I can share my screen.
Yep, if you click on, I think, share screen or something to that effect, you should be able to, or share content, you should be able to take the screen.
I will stop your screen then.
Yep, no problem. Go ahead.
Okay, so I think this is the screen I'm sharing.
I'll be honest, I don't even know what you're talking about today.
I don't know. I decided that I'm going to talk about corporation structure today. So
that is the most common question that we always get. The people always ask us, should I incorporate if I'm investing in real estate, should I incorporate? And I'm like, I don't know, go talk to Sherry. I don't know.
Thank you. Thank you. So can you see my screen right now?
Yes, we can.
Okay. Okay. So at any point in time during the presentation, you find this too dry, is normal. I'm not trying, I'm just trying to set the bar really low because this is corporation tax. And it's a hot night out today. My kids are outside hunting beaver. And I hope you guys will enjoy this presentation and you will learn something from the presentation. So I'm just gonna get started. So a little bit about myself, that's me, no makeup on there. And I wrote a book called Complete Taxation Guide to Canadian Real Estate Investing. I think last year it went on the Amazon bestselling list. I didn't do any trick to get on the Amazon bestselling author list. So this is for real. Somehow the people bought this book often enough that I was on the bestselling author list. So it's if you have not seen the book, it's available on Amazon if you're interested in it, or you can sign up on my blog. I think we do sell it somehow on my website, and my website is realestatetextips.ca. I am on all the social media. realestatetextips.ca is my website, and then Instagram and Facebook. Follow me because I have a competition between me and Erwin, who has more followers. So far, I've been beating him out from the Instagram side, from Facebook side, and from YouTube side. I've been beating him. There's a constant competition between me and him on every single front, from revenue generated to the followers. So, and to the number of kisses that we get at night from our kids. So a little bit about myself. I am a chartered accountant. I graduated from University of Waterloo a few years back. I wanted to say a few years back, but this year our firm hired a co-op student from Waterloo again, and I realized that I would be old enough to become their mom. It's such a sad thing. I started as a co-op student, and now I hire a co-op student that I would be old enough to be the mom. Anyway, but I graduated a few years back, and I've worked at Deloitte, which is still, I believe, the biggest accounting firm in the world, in the small business private company services group. And now they sold it to a different accounting firm. And I also have done a few things. I have invested in a few investment properties. I have student rentals, and I have one property that I seriously consider having laneway house on. We didn't end up doing it and sold the property, but it was such a timely conversation to have. I also have my own accounting business, and I fund my property purchase through my business profit. So today I'm going to share that part of it. And today I also brought in this what every real estate investor needs to know about repairs and maintenance webinar that I did exclusively for my clients only. So we did it last month for my clients about repairs and maintenance, whether you would be able to write it off, or if not being written off, what does that mean to your business? If you go to realestatetextips.ca/volition, this is a special offer. Special offer. If you go over there and you sign up, you will get access to the video immediately. So that's going to help you prepare for your taxes as well, and potentially push certain buttons so you would be able to claim certain expenses more aggressively. To start off, I wanted to say that I'm not responsible for anything I say here. That's generally accounting talk. You have to, accounting and tax planning is very individualized. I want you to be able to consult with your accountant and have your accountant plan it out for you. Knowing all the full picture of what you have in your life. So it's not just, do not go out and just implement what I teach you tonight, because it may not be a fair representation of what you have in your life. Accounting and tax advice are very individualized. It's very based on your circumstances. Now, a little bit of agenda. We will go through some Canadian tax system to understand the tax concept, and then we'll go through the 6 questions to decide whether you should set up a corporation or not. And then we'll go through some common corporation structure And then we'll talk about even the next step. Even like some of you might be business owner, you might have already got that corporation structure, what's next for you? And then I'll go through some questions and answer that some frequently asked questions, or if you guys are up for it, I'm open to answer some of the questions that you may have. So our Canadian tax system is built on this system called progressive tax system. Essentially, the more money that you make, the more tax you have to pay. So what does that really mean? Well, what it means in number wise is that between $12,000 to $45,000, you pay 20% tax. So the way that it works is that you take 45,000 minus 12,000. That difference of about $33,000, you multiply by 20%. That's the amount of tax that you would have to pay. Now, if you earn less than $12,000 in the year, you pay $0 because that's called personal tax exemption. So essentially, if you make a salary of $45,000, you take that $33,000 delta times 20%, which is $6,600. That's the tax that you would have to pay. But on the flip side, if you make $150,000, you have to go through the calculation between the 45 minus 12 times 20%, 49 minus 45 times 24%. You go through the entire calculation. Your highest marginal tax rate is at 43%. So for every dollar that you earn, every dollar that you earn above and beyond $97,000, you would have to pay 43% tax. And so 150 minus 97, that $53,000 is subject to 43% tax, and it doesn't end there. If you are one of those lucky one that makes over $220,000, for every dollar that you make over $220,000, CLA gets to keep 54%, and you only get to keep 46%. It's pretty sad in a way because CLA gets to keep a bigger share than what you would get. Now, but this also presents an opportunity. So if you look at these two slides, you know that every single year you get this fresh set of low marginal tax income, taxable income, low marginal tax rate. And every single person in Canada, every single year, get a fresh set of this low marginal tax rate. So what it means is that all the income tax splitting, all the like the tax planning out there is about income splitting. It's about splitting the income among as many people as possible in a majority of the time is in the same family system, in the same family. So I want to utilize my wife's or my husband's low income or my kids. The more kids you have, it may be the more beneficial, the more taxes you could pay, you could save. So these are the planning point that you have to keep in the back of your mind. So every single tax planning strategy in the back is always about splitting income among as many people as possible legally without triggering an audit. Now, just to give you an example, if you have a job income of $100,000, you go through that calculation and your total tax bill is about $24,000 because that's how the tax rate works. Now, what if you get a bonus of $50,000 from your job? Your additional $50,000, like I mentioned, is going to be subject to 43% tax rate. You pay $21,500 on the additional bonus that you would get. But then your tax on your first $100,000 that you earn is only subject to $24,000 tax. But the tax on the second $50,000 that you earn is you're paying almost the same amount of tax as your first $100,000 because of the low marginal tax rate in the first $100,000 that's subject to. $100,000 that is subject to. So the total tax payable is $45,000. It's not necessarily working. You can't work harder to get your bonus. Essentially, you have to work smarter. You don't want to pay additional $21,500 to CLA. This is the reason why people invest in real estate, because long-term real estate, you're going to earn capital gain on the appreciation when you sell the property, and capital gain is only 50% taxable. If you earn $50,000 capital gain, only 50% of it is taxable. So you would pay half of the $21,000 to CLA, not $21,000. So it's important to work smarter and invest smart by investing in long-term real estate or long-term stock. Oops, this one. Now, what's corporation tax system? How does the corporation tax system work? Well, the corporation tax system basically says that if you earn active business income for the first $500,000 in any given year, for qualified active business income, is subject to 12.2% tax. So for real estate agents out there, or for any business owners out there, if you net under $500,000, you would only pay 12.2%. Now, 12.2% is way better than what we see here, right? 43%, 38%, 34%, way better. So this is the little incentive that the CRA is giving small business owners incentive to operate a business in the corporation. Now, if you are making more than $500,000, or if you have any other criteria that disqualify you to claim the small business deduction, you will then pay 26%. 26% on your net income is still significantly better than your whatever you're paying in your personal tax system, under the personal tax system. But the problem is that rental income, taxable capital gain, dividend income, all these royalty income, all the income listed in front of you are considered something called specified investment business income. And they're not taxed at 12.2%, they're not taxed at 26%, and they're taxed at 50%. They're considered passive income, also called specified investment business income. Now, they are taxed at 50%. They go through this system called refundable dividend tax system. You get a refund back eventually when you pay. So using an example, if you earn net rental income of $10,000, the $10,000 would first be taxed at 50%. But you can potentially, the corporation can potentially get a 30% refund back, can get $3,000 back from the government. Out of the $5,000 that you pay, $3,000 will be coming back to you. So you net overall will only pay $2,000. Now, how do you get the refund, the $3,000 refund, the 30% refund? The way to trigger this refund is by way of declaring a taxable dividend. Now, you issue a taxable dividend. The way that you issue dividend, the only person that can receive the dividend is being a shareholder of the corporation, whoever that's the shareholder. So that also means that when the shareholder receives the dividend, the company would issue a T5 slip to the shareholder. The shareholder has to report that dividend as personal income, and the shareholder has to pay the personal tax on the dividend income received. So the income on the, for example, the $10,000 that I mentioned, the actual tax that would be paid on that dividend income is the corporation tax of 20%, because it's 50 minus 20, 30% refund, 20%, and then plus the personal dividend tax. Now, so how do you utilize what you just learned to lower your taxes? Remember, you want to spread your income to as many shareholders as possible, especially we want to declare the dividend to people who are earning very little income in your family. So we want to declare dividend to low-income spouse or low-income family members to utilize their low personal income tax rate. And so then the personal dividend tax rate would be significantly lower than the main breadwinner who is earning $220,000 salary and up. So this is the idea of using corporation to split income among the family members. And that's how you would be able to lower your corporation tax, lower your overall tax among your whole family members. Now, you may wonder, hey, like, is there a chance to pay double tax because I pay corporation tax of 20% and I also have to pay personal dividend tax? Well, the system is designed in a way, our tax system is designed in a way that the combine of the corporation tax and personal dividend tax would be the same as what you would otherwise pay in your personal name if you were to own the property directly under your personal name. So there is no double taxation. The key here is to utilize the right shareholder in the structure to make sure that the low-income shareholder receiving the personal dividend to lower the personal dividend tax rate. And that is going to help you lower your overall family taxes. Oops. So we talk about tax integration. Now, corporation can save you taxes if you structure it correctly. Remember, when you set up a corporation, you have to decide the shareholder of the corporation. And by having the right shareholder as in place at the very beginning when you set up the corporation, you would be able to declare dividend to them and hence lower your taxes. And that is the way, that's why it's important to make sure that the proper share structure is in place for the corporation to begin with, and the shareholder, different shareholder issue different type of shares, so to allow maximum tax efficiency, tax distribution efficiency. So this is the reason why the structure on its own is very important. Now, what are the criteria to decide whether you should set up a corporation or not? Well, the first thing first, it's your investment strategy. Now, I mentioned the whole passive income, specified investment, business income, everything. But that is just one way. Typically, we refer to that specified investment business income, the 50% passive income tax rate, as it's one way of generating, one way of investment. But there are other investment strategies available. So for example, people in Toronto also often do a lot of assignment deals for pre-construction condos. And assignments, generally speaking, they are considered active business income. So when it is active business income, it falls under the 12.2% bucket. 100% of the profit that you make from selling assignments, flips, land development, and rent to own would be considered 100% taxable. It's considered also active business income. And if you report them in the corporation, you only pay 12.2%. So if I earn $100,000 from a flip, that net $100,000, 100% of it is taxable, not 50%. Just because you sell a house, it doesn't mean that it's 50% taxable. So that $100,000, if it's being housed in the corporation, you only need to pay 12.2% corporation tax rate. Now, if I use the same example, if you buy a house and sell it the next year, or a couple of years later, and you make $100,000 capital gain, that's considered long-term buy and hold. And it could be student rental, multi-unit residential, condo, single-family home, commercial properties. Anything that's long-term buy and hold is considered capital in nature, and therefore the profit that you make from the sale of the property would be considered capital gain. Capital gain in the eyes of CLA would only be considered 50% taxable. So that 50% taxable amount in the corporation is going to go through the refundable dividend tax system that I mentioned before. Out of the 50% that's taxable, so that $100,000 example, $50,000 would be taxable in the corporation. That $50,000 taxable amount is subject to 50% tax rate, and then 30% would be refundable if you declare a taxable dividend. So it really goes back to your investment strategy. If your investment strategy is assignment, flips, land development, rent to own, by all means set up a corporation, because there is a lot more flexibility in the corporation to defer taxes and split income. Now, if your strategy is long-term buy and hold, then you have to consider the rest of the consideration. Then decide whether you should set up a corporation or not. Do you want legal protection? This is also one big thing. I see that our investment in the corporation, investment in Toronto often includes multi-unit, conversion to multi-unit. In Toronto, maybe it is it's not nearly as risky because the tenant profile is slightly different than the area that I invest in. In Hamilton, I invest a lot in Hamilton, and the tenant profile generally are not as nice. And so there could be significant damages done to the house. In one case, my client who owned a property in, I think, Oshawa, owned a triplex there. And I remember that there was an accident in the basement of that property. And it was the basement tenant who burned some marijuana oil. And somehow it blew up the entire house, and the entire house got lifted up by like a couple of inches. People could see it. And so nothing happened, thankfully. Everyone was safe, but then the house was deemed unfit to continue to be occupied. So the house has to be torn down, the whole house. The insurance policy, the first thing that they do is that they go back to the policy and fine prints to make sure that the owner, so the investor, actually comply with everything. Thankfully, she complied with all the fine prints. But ever since that particular situation, she's decided to put everything in the corporation. I don't know if you feel that if the insurance policy is enough. Insurance company is in the business to generate profit for their shareholder as well. So when I go through an insurance claim, the first thing that the insurance company would do is to try to find ways to get out of your claim first, to not insure you. So this is the reason why a lot of my clients choose to own properties inside a corporation, because they feel that the insurance policy is not enough. Now, if you buy insurance from Hub Commercial Property, I have commercial insurance on all my properties as well. If you feel that that's enough, that's fine as well. But one of the considerations you determine whether you set up the corporation or not is whether you feel comfortable with the insurance. And don't forget, the next thing that you have to think about is you have to understand that, okay, my insurance could be enough or may not be enough, or you feel that it's enough, you just don't know. What people don't understand is that they are exposing what they own personally, everything. So I also had a consultation once that this lady came in and she wanted to buy student rental, and she got a bunch of money inheritance from her late mother, and she got like maybe $400,000, $500,000 inheritance, and she decided to invest in student rental. The problem is that she owned her Burlington home all fully paid for. At the time, it was 1.5 million. That was a few years ago. In today's dollar, it could be 2.5 million or $3 million, fully paid off. And then she also has like $1 million in her RSP. Now she has all cash. And now she has an additional $400,000 that she's planning to put into student rental. Do you feel comfortable to owning a student rental? If I were her, I would totally put that student rental inside a corporation just to have another layer of insurance. At least it's not going to affect my personal asset. And so like that's really why we have to understand what we're exposing as well, not just saying, oh, my insurance policy is enough. Maybe your insurance policy is enough, but do you really want to risk everything else in your life as well? So that's the question that you have to ask yourself to determine whether you should set up a corporation or not. This is basically a visual to explain to you, if you own everything in personally, everything could be at risk. Your rental portfolio, your business, if you own your business in your personal name as well, everything in your personal name, all of your rental properties, not just the one that's in question, would be exposed. Your cottage could be exposed. Your stock in personally owned stock portfolio would be exposed. Everything. Now, life insurance policy, I was told that may or may not be exposed, but let's say that it's exposed. Everything in your personal life would be exposed. But if you separate them, you can consider that the rental portfolio is in a corporation. In this long rectangle, you're only risking the rental portfolio against the rental portfolio, other rental properties. So that's like if you set up a corporation to own your business on its own, then the business risk is limited in that particular legal entity, the corporation entity. So that's the reason why people set up corporation, to just to essentially segregate risk. Some people even go as far as setting up family trust, because that family trust would allow you to distribute income among different family members, and then also provide an additional layer of protection. Now, are you planning to buy more than one property? This is often very important. It really goes back to your long-term goal. Setting up a corporation costs a lot of money. Maintaining the corporation on an annual basis costs money. And I don't want to charge people a lot of money, but that's just how it is. It takes up the labor to file the tax return. There is so much more filing that you have to do, so much that you have to pay for. But owning the properties in the corporation, if you are not planning to buy many properties, if you're only planning to buy one property and there's no other reason other than just that particular property, and you're not planning to buy any more property, it may not be worthwhile from the cost benefit, from the dollar figure, the cost to maintain the corporation point of view. It may not be worthwhile to set up that corporation. It really goes back to your particular situation. Not every single property is going to cash flow like the one that's presented earlier for like almost $1,000. Not every single one of them is going to be like that. So the cost to maintain it is high. If you have many properties inside the same corporation, the cost to maintain the corporation would be spread out among multiple properties, and which will be way cheaper. Do you own another small business? This is also very important. I mentioned earlier that I own my accounting practice. I use my accounting practice profit to invest. So for example, if I earned that $100,000, we went through the exercise earlier to calculate earning $100,000 job income in the personal name, you have to pay about $24,000 of tax personally. But if I were to earn that same $100,000 in my corporation, I only pay 12.2% tax. So let's say 12,000 versus 24,000. So I essentially would be able to defer that $12,000 tax. I could put that if I invest the after-tax profit in my corporation, I have an extra $12,000 to invest in properties compared to if I had to take the money out and pay another layer of personal tax, and then I invest. I have $12,000 less, and I'm only talking about $100,000. If you are talking about like $400,000, $500,000 tax net income, you have a lot of tax deferral available if you invest inside a corporation. Essentially, you're using CRA's money. You're using the money that you would otherwise pay to CRA as personal tax to invest in the corporation structure in your favor to generate wealth for yourself. And that's why a lot of small business owners would invest in the corporation. Now, how much money do you need personally from your small business? Like if you take out everything from your small business to live off and you spend a lot of money in your personal life, then there is no point setting up that corporation. There's also nothing left to invest in the corporation as well. So then if you spend everything inside the corporation, then you shouldn't invest in your corporation. Well, chances are you wouldn't have any money left to invest to begin with. Now, are you planning to leave portfolio to the next generation? The challenge is that a lot of our tax planning involves something called an estate freeze. An estate freeze includes the use of a corporation and a family trust and all these things. When you own all your properties in your personal name, and then you decided, okay, I want to leave all these assets to my kids, and I want to do an estate freeze and transfer all these assets to a corporation and give it to my kids. At that time, when you do the transfer, you will trigger the land transfer tax at the fair market value at the time when you do the transfer. So if you are buying one of these Toronto house, your laneway house, and then the properties keeps increasing. The properties keep increasing in value, and you have a few of those in Toronto. Imagine the amount of land transfer tax that you would have to pay at the time when you're ready to transfer and do the estate freeze and pass it on to your kids. It's crazy. So it may actually be worthwhile just to set up the corporation from the get-go to own these properties at the beginning, from the beginning onwards, and you would not have issues later on costing you tens of thousands, if not hundreds of thousands, because by that time you have to pay land transfer tax on Toronto land transfer tax as well as Ontario land transfer tax on the fair market value when you are ready to do the transfer. So on the fair market value. So it could be 10 years from now, 20 years from now. So that cost is also has to be taken into consideration as well. Now, there is no one size fits all solution. You need to understand your particular situation, your own priority, your goal, because the reality is if you're only buying one, may not fit you. It may not be worthwhile. But if you're thinking of, hey, like I have a small business, but I'm buying one and I'm also considering limiting my risk, then it might be beneficial just to set up a corporation for that. And the last thing that I didn't mention here that I recently discovered is something that I call a strategy called mortgage version. I don't know if you guys have heard about the mortgage version strategy, but this mortgage version strategy, let me see, 8:26, I still have a little bit of time, so I can share this mortgage version strategy. So this mortgage version strategy is a very interesting strategy. What happened is that we discovered it by accident, is that when you own a property directly inside the corporation's name, even if you personally guarantee the loan, because the bank wants guarantee from everyone if they can get it. So they normally would require you personally guarantee the mortgage, even if you own the property directly inside the corporation, on the corporation's name. Let's say I have this corporation called ABC Properties Inc., and I use ABC Properties Inc. to own ABC 123 ABC Street. Now, this, I have to personally guarantee, I have to sign off to personally guarantee as the owner of the corporation. I have to personally guarantee, I have to qualify, submit all the documentation. What happened is that I found that the bank would register something on your personal credit report, but that is not a mortgage. It's just a guarantee. So when you try to qualify to buy your next property, the banks see that that guarantee. They don't take into consideration that you already commit to. They may or may not take into the consideration of that guaranteed mortgage. So they would reuse your current credit and allow you to qualify for an additional mortgage, a different property mortgage, additional mortgage for a different property. So essentially, you could leverage the multiple corporation structure to allow you to reuse your personal credit to buy multiple properties in different corporations. I've shared this strategy with a few people, and they what people started doing is that they started buying directly inside a corporation and save their personal credit for something bigger and for something down the road. So they're trying to reuse their credit for as much as possible. You still disclose everything to the bank, but whether or not they use that mortgage for your qualification, the old mortgage, the mortgage that's inside the corporation, to calculate your qualification for your next purchase, it's up to them. It's just that what we found is that if it is just a guarantee, it's not registered against your personal credit report. It's registered differently against your personal credit report. And the bank may choose not to use that to calculate your TDS and all these ratios to qualify you for your next purchase. So that's something very interesting. I thought that I would throw it in there. Now, common corporation structure. One corporation, multiple properties. It's super easy to set up, suitable for the beginner, low cost to maintain, low risk. It's great for low risk houses such as single family rental, small multi-unit, rent to own, student rental as well. And of course, we talked about risk before. The more properties that you put into the same real estate corporation, the more risk you're exposing the properties to. That's under the same umbrella. So if I have 3 properties within that corporation, the legal structure, essentially if I get sued by house number 3's tenant, I am also exposing the equity of the other 2 properties that's owned in the same umbrella. So people often ask me, hey, like Cherry, are there, how many properties can I own within a corporation? From an accounting perspective, you can own as many as you want. You can own 200, 300, 400, as many as you want, as many as you can get. But it is how comfortable you are exposing the risk of operating all these other properties in the same umbrella, legal ownership structure. So that is up to you to decide. Typically, a lot of the people own like 4, 5, or 6. And then they decide to set up a second corporation just so that they won't be exposing too much risk to the newly purchased properties. Of course, if you're not comfortable, you can always set up one corporation for one property. Now, but then the setup cost is high, the tax rate is the same, there is no benefit to set up multiple properties in multiple corporations. You may lose the ability. So if your portfolio is large enough, there is a way to lower your tax rate from the 50% to 26% or 12.2%. If it's not owned in the same corporation structure, you may lose that ability to claim it. And you can also do suitable, but this strategy is particularly useful for large multi-units and commercial properties. It's way easier because I have clients who own 100-unit apartment building. They would own it in one corporation structure because they don't want to mix that 100-unit apartment building with the commercial building that they own. Because in commercial property investment world, if you think you would get sued, chances are you would really get sued from like slip and fall and all these crazy stuff. So you don't want to expose to different type of risk, and that is when you would choose to set up a corporation for one property. Now, for other, I've also heard stories, not from my clients, but I've also heard some really advanced real estate investor would buy one property in one corporation, just so that they are not like, so this would go with bank number one, maybe RBC. I'm just picking random name here, RBC, and then corporation number two could be with CIBC. So they still see your personal credit report that you're guaranteeing the loan, but then the way that they do the calculation does not account for, sometimes it doesn't, I'm not the mortgage broker or the banker here. Sometimes they don't take into account what you've already purchased, what you're guaranteeing the loan for. They don't calculate it. So they don't include the initial mortgage from RBC to qualify you for your CIBC mortgages. It might help you and it might be beneficial if you structure it properly to have multiple corporations for multiple properties with different banks. Now that's another consideration that you want to have when you structure your investment portfolio. Now the three-tier corporation, the famous three-tier corporation, is not as popular these days because the cost to maintain it is so much more expensive. Essentially what you do is that some genius accountant out there recognize that there is the property management function within a real estate ownership investment portfolio. So they decided to set up a separate corporation to carve out that property management function. So this property management company would operate on its own and manage the properties that's owned by the real estate corporation. And whatever property management income that's owned by this property, that's being charged by this property management company, is only subject to the active income rate, which is 12.2%. And then the real estate corporation would only pay tax on whatever that's residual after paying the property management company. Now, the downside of this setup is that there is a lot of paperwork to be done in order to set this up properly and to maintain it as well. If you think having one corporation is bad enough, try having 3 or 5 corporations. It sucks. It's a lot of work. Like CRA look at this structure and they look at the actual cash transaction and see if there is really commercial substance in what you try to do here. You are allowed to do it, but the thing is, majority of the real estate investor out there don't have the time to commit to transferring cash from one bank account to another bank account, or issue invoice or sign an agreement. So all the back-end work is often not done. And so this is the reason why, like, a lot of the three-tier corporation, even though it was set up, it was not implemented properly, and it might not stand up in court if it's ever challenged by CRA. Now, the second downside of this whole arrangement is that a lot of the people, once they set up this structure, they decided to claim all their expenses through property management company. And at the end of the day, the property management company has a loss. Remember, the whole point is that we want to have the real estate corporation paying less tax and the property management company paying more tax, not more tax, but have reporting more income and pay 12.2% and have less income in the real estate corporation to pay 50% tax. Some of the investors that I've seen that have this structure set up often report a loss in the property management company, which completely defeat the purpose of setting this whole thing up. So like there's a lot of detail that has to be implemented to make this whole structure effective. But if it is done right, it could save you some taxes. Now, so after you set all these up, these great structure, what's next? I don't have the next slide. What's next is really another level of investing. So buying real estate is one way of investing. What I've seen in the past is that people, on top of investing in real estate, they would also buy a whole life insurance to protect their family and to prepare for the terminal tax return. They could also use corporation fund to do that. People also use the after tax use the corporation also to do other investment such as stock trading. So all these other options are available within the corporation to allow you to grow, to take your business to the next level. And again, a little reminder, if you haven't already, hop over to realestatetextips.ca/volition, and you would then be able to get access to my client-only webinar. I think that basically concludes my very dry presentation. I don't know if there are any questions. I think there are 22 comments.
No, that's great, Cherry. This is the #1 most asked question that we get around accounting. Should I incorporate? So thank you for very succinctly summarizing, all the pros and cons and all the ins and outs. So I really appreciate that. Question for you. Are you currently taking on new clients? Like, how is your practice and your availability and capacity?
So we're constantly looking for new clients. My team would meet with my team member who has 20 years, actually 30 years of experience. We'll have the initial consultation with the client first, and then we'll decide whether that person advise based on the structure or the circumstance of the client to see if there is a need to set up a corporation, and then we can work from there.
Good stuff. Good stuff.
Mm-hmm.
The questions are rolling in. I'm going to ask Shelby, how diligently have you been recording them, and can you serve up a few to Cherry?
Yeah, definitely. We've got lots. So I'll start with one from Will.
Mm-hmm.
And Will is wondering, is there a cost-effective way to transfer ownership from a personal name to a corporation? He's heard asset rollover is used to do this, and he'd like to know your thoughts and any guidance you might have.
Absolutely. So if you own a property in your personal name and you want to transfer the asset to the corporation, there are essentially two types of taxes that you would have to pay. The first one is the land transfer tax, which is unavoidable. There is no way to avoid it. The second one is the income tax. Now, you can use something called a Section 85 rollover, essentially a tax-free basis, on a tax-free basis.
Sorry, was that just me that saw that Cherry, we lost her for a second?
No, it was.
No, I see it too.
Okay, do you mind rewinding 10 seconds or so?
Okay, so there are two types of taxes that you would have to pay if you transfer assets from the personal name to the corporation. One is the land transfer tax, unavoidable. Land transfer tax is calculated based on fair market value of the asset at the time when you transfer the property. Now, the second tax is called income tax. So when there is an appreciation, presumably there is an appreciation of the asset of your rental property. Let's say it appreciates for 100,000. So if you sell it to the corporation at fair market value, you will have to pay capital gain tax on the additional $100,000. But CRA allows you to roll it on a tax-free basis to the corporation, and you don't have to pay tax on that $100,000. And that's the tax-free asset rollover that you would be doing. And a lot of my clients are actually using the tax-free rollover to sell it to the corporation.
Will, does that sufficiently answer your question? I'm going to say yes.
Yes, sorry. It took a while to unmute, but that was very helpful. Thank you, Cherry and Matt and Shelby.
Good stuff.
You're welcome.
Shelby, what was the second most interesting question that you saw?
What is the cost to set up and maintain a corporation?
Typically, depending on the type of professionals that you work with, setting up a corporation could be as little as like, I believe if you go online and set it up yourself, it could be as little as like $200, maybe $300-400. But if you want a proper structure, having the right things in, like right articles, right clauses in the articles of incorporation, then you have to engage with your with the professionals. And even if you go to the lawyer, they may not know what kind of articles you are looking to. Remember that you need to have different shares, and if you are planning to roll some of your assets into the corporation or have the potential to roll these assets into the corporation, some special shares, some special clauses must be included inside the corporation to make it work. And so that is, so you have to engage with a professional accountant. We set everything up for $2,500, but if you work with some investors like us to work with a lawyer to set it up, which is totally fine. We just write a letter, and that would typically cost more because then you have to pay the accountant and then you have to pay the lawyer as well.
Are there any advantages to just letting you open up the corporation versus you writing a letter of opinion or advising the lawyer to do it?
We do the setup because we want to help our clients save a little bit of money.
Yeah.
We have been doing it for a while already.
So there's no particular advantages to engaging a lawyer or getting you to write a letter to the lawyer. That's just more overhead.
I don't want to answer that question if there are lawyers on the call.
I'm gonna answer it for you. I've gone both ways where I have got my, an accountant to write a letter to the lawyer. It was less efficient and costs more. So that's I was teeing that up for you to knock it out of the park, but there you go. Yes, the answer is there's not really any advantage. So thanks, Jay. Okay, Shelby.
Sorry.
No, that's the answer that I was looking for. So thank you. Shelby.
Okay, our next question: can every type of small business invest in real estate inside of their corporation?
So I'm assuming that, like, I'm using myself as an example, and so I'm assuming this person is referring to a corporation that already has an existing business. So, for example, I have my accounting practice. My accounting practice is in my a professional corporation, is in the corporation. Now, there are, depending on what kind of business you are in, if you're governed by a specific professional body, they may or may not allow you to buy investment properties. So if you're not governed by any of that, you're not like governed by like CPA Ontario, you're not governed by like the medical professional as well, then you are allowed to set up to buy the properties directly inside the existing corporation if you own the business, your existing business. Now, there are only two reasons why you may not do it. The one reason is that you might just operate, you might operate a food business and you don't know, or pet food business, you don't know when people are going to sue you. And if you put all your investment properties in the same corporation, again, you're exposing your rental portfolio, long-term investment, essentially your wealth building asset to the business that you own, that you might be getting sued from. And that's one reason. So you may want to separate the risk, and by setting up a second corporation, you will be able to separate the risk. Now, the second reason you may not want to set up, a corporation is, remember earlier that it is not easy to qualify for financing inside a corporation. More often than not, you have to work directly with the bank. Some mortgage broker will be able to help you to get qualified in your corporation for you, but some majority of them, I find it's harder. Now, if you do have a corporation and you work directly with the bank or even with mortgage broker, it's the same way. They like to work with something called holding company. Now, what's holding company? Essentially, it's a company that only hold real estate investing, or stock portfolio investment, but do not own anything else, do not earn any active business income. Earlier last year, I was trying to qualify for financing with RBC inside my holding company, and I reported $2,000 of consulting income in that corporation, in the holding company. The first underwriter said, okay, that's fine, we don't care, and just approved the loan. But then that underwriter went on vacation. And so second underwriter came in and saw that $2,000 consulting income and decided that this is not a holding company because you earn $2,000 active business income here. So I'm going to pull the mortgage. So that's my personal experience. And that's from the conversation with a lot of mortgage brokers. The bank don't like to work with non-holdco company. Hopefully that answered the questions.
No, thanks. That's is it okay if I just add on a couple of experiences that I've come across as well? So I think someone talked about a health professional corporation. So my father-in-law is a medical professional. He's a neurologist. He runs a neurology practice, and as a medical professional, he was allowed to only own the location, the building that he's operating his practice out of within his professional medical corporation. So as Cherry was alluding to, certain, depending on the governing body for whatever it is for your profession, it can dictate whether or not your, for example, professional medical corporation is allowed to own real estate or not. In this particular case, it could own the area, the building that you're running your practice out of, as an example. And then I did see another question. It's an adjunct question. Where was it? So this is from Kelly. How do you use, is this Kelly or is this Mike Meckes? I bet it's Mike Meckes. His wife is Kelly. How do you use money earned in a professional corporation to buy real estate if your regulatory college does not allow you to buy real estate as part of the active business activities in that professional corporation? So Cherry, I'll turn it over to you.
So I would set up a second corporation and then essentially loan the money to your second corporation that just does real estate investment. The real estate company would pay interest to your professional corp for the fund that you borrow from. So essentially just set up a loan arrangement and then you buy the investment properties that way.
Yeah, exactly. So the key there is you're basically moving money from one corporation to another via share through a loan to that corporation, but has to be properly documented with an interest rate. Mike Meckes / Kelly is asking, Holdco, what's your question around specifically, Mike? You can unmute yourself if you want.
I just got lots of noise in the background. You guys hear me?
Yeah, I can hear you perfect. It's fine.
Yeah, so Sherry, thanks for answering that question. So I guess that second corporation would be a holding company, would loan the money to from the Prof Corp?
Borrow money from the Prof Corp, yes.
Okay, and as long as there's a prescribed interest rate, then
yes.
it's okay within
yeah.
the professional bodies.
Mm-hmm.
Okay, great. Thanks very much.
Cool, thanks, Mike. Thanks for the question. Okay, Shelby, any others to serve up?
One just came in. So when you purchase under the
can't hear you.
Are you qualifying for a residential mortgage?
Can't hear you. Can't hear you. Hello?
Oh, my internet is unstable.
Okay, why didn't I read it? I'm assuming it's the last question from Godfrey. Okay. When you purchase under the Holdco, are you qualifying for a residential mortgage or a commercial mortgage? This actually sounds more for like a mortgage broker, but go ahead.
Yes. So I talked to a mortgage broker regularly, more than regular. So depending on the bank that you work with, to be honest. So late December, I refinanced my 3 properties that I own inside the corporation with Meridian. The way Meridian structured, Meridian Credit Union. So it's not technically a lender, but I qualify it, I refinance it, and it's inside a corporation and it's under a commercial mortgage. But my understanding is that with talking to my bankers at Scotia, you're still qualifying under residential. So essentially, different banks have different policies and rules depending on your particular situation. I think one thing that I'm sure you guys talk a lot about as well is how to qualify for the mortgages. And some people use for high net worth individuals, some people use, like, for example, Scotiabank high net worth program, and they always give you 65% without questions if you are enrolled in their program. So it really goes back to the type of relationship that you have with the bank, as well as the banks that you work with, because different banks have different policies. So my Meridian would be considered commercial, but if I took that 3 mortgages to, like, say, CIBC, it would have been considered regular residential.
Yes. So I know that we got a couple of mortgage brokers on the line here. I think Lauren Pye from, oh, there she is. She just posted from Vine is, Vine is one of our lender partners, and we work very closely with Vine. A lot of you on this call are Vine clients as well. So the answer is really, it depends. I hate that answer, but there's a reality around it. Your situation, there's no blanket answer that's going to answer your specific need necessarily. There's so many different ways to answer this question. I'll give you another example, if it's okay for me to share my experience. So I own a bunch of properties across a bunch of different corporations as well. I also own some properties personally. Within the corporation, one way that we used to do it was we would have me, Matthew Lee, down on the offer on legal title and mortgage, but then we would transfer the beneficial ownership over to the corporation. So legal ownership is Matthew Lee, beneficial ownership is corporation XYZ, right? And what this allowed us to do was get normal residential financing using normal GDS TDS ratios, nothing fancy. I would then become the owner of the property on legal title, but then I'd write an email to my accountant saying I transfer beneficial ownership of the XYZ of this ABC property to my corporation XYZ, or a corporation to be named later. And it's a way for us to still get residential financing, to not really confuse the mortgage brokers with their tiny brains. No, not the mortgage brokers. The mortgage brokers are good. It's usually the underwriters over at the actual lenders with their tiny brains. But the reality is they don't know how to deal with corps. And the beneficial ownership, transferring it over, it's a beneficial trust agreement. And what it allows us to do is it's the best of both worlds. I can get the financing and I can transfer beneficial ownership over to the corp, meaning that it's the corporation that files the tax returns, it's the one who receives the rental income, so on and so forth. So anyway, that's just my personal experience.
Well, I think that's a great share, because those are, like, a lot of the people started out by buying inside a corporation, but they find it super difficult to get financing. But it's way easier to get financing in their personal name. So that's how I started as well. I purchased my properties in trust for the corporation. I report everything from day one on. It's important to know that it's from day one on to inside the corporation. And what this does is that you need to set up a trust agreement. A formal relationship has to be formed between you personally and the corporation. Now, once you set up a trust agreement, you have established that trust relationship. There's a couple more steps that you have to go through, but essentially when you're ready, you can transfer the legal title from your personal name to the corporation. So that's what I did with Meridian. Meridian allows me to own the properties directly inside the corporation. I was with Scotia before, set up under the traditional way. Title is owned by Cherry Chen, and then I own it inside the corporation, and then I do the transfer. With this trust agreement or trust relationship, when the transfer happens, there is no land transfer tax paid, no land transfer due. But you have to report the income and expenses, assets and liability from day one onwards inside the corporation. Now, once I move it over to Meridian, I check my personal credit report, and then miraculously, it's no longer there, even though I personally guarantee the Meridian loan. And that's how I find out. So the natural progression for people is that you set up the corporation right from the get-go. You still work with regular mortgage broker, and then you buy it in trust for the corporation. And then when you get to the point, hey, like I want to qualify for more financing, I want to buy more than the 3 or the 5 that you're planning to buy, and you're hitting the wall to get financing, you start transferring some of these legally owned by you, but truly owned by the corporation property directly to the corporation. Transfer the property mortgage directly to the corporation as well. So then it gets removed from your personal name, you free up the credit, and then you buy more properties.
That's a really good share. I haven't gone as far as actually transferring the legal title over to the corporation. I haven't had a need to do so quite yet. But there, in another instance, in one of my corporations where I bought a bunch of properties, for whatever reason, CIBC was running a program that allowed me to get mortgages directly using their DCR lending program. I needed a corporation. I needed the title of the properties to be in the corporation's name, and then they put the mortgages in the corporation's name as well. Like you said, I had to personally guarantee them, but they didn't, like you said, they didn't hit my credit report. So I could go, CIBC knew about them. I could go to another bank and go get financing as if I did not even own those properties. So yes, your example with where you're sharing that the corporations. Mortgages that are held within corporations, other banks don't know about. It can be a way around the financing wall as well.
Like I can't say my mortgage broker was really upset when I say that other banks don't know about. But so what I do is that I disclose everything. So after I transfer all my properties owned in trust for the corporation directly to the corporation with Meridian, the funny part is at the same time I was also buying my new house, trying to qualify for the mortgage. And I went to Meridian, and Meridian, who knows about all my properties, because I just did the transfer with them. They just gave me 3 mortgages on my investment properties inside the corporation. They know about it. They did not include the calculation in the qualification for my primary residence, which is very interesting experience. And everyone could use this as I don't encourage you to do mortgage fraud. Just tell them, and they just don't use it. It's up to them, right? It's not up to us.
Yeah. It could be the underwriter. It could be done on exception. There's. But thank you for that, Shelby. Any others? Any other questions you saw? You unmuted yourself, but I can't hear you. Okay, let me just go through. I think Shelby's having some technical issues. Okay, well, anyone else on the Volition team, can you serve up the questions? I'm going through okay, someone on the Volition team, help Shelby serve up the questions. Meanwhile, I've got a few. You were talking about the 30% refundable dividend within the corporation. Is that also known as, or is it different than the capital dividend election?
It's different. So capital dividend election is a special election when you earn capital gain. So like, let's say you sell a property and you make $100,000, and it's a long-term buy and hold property that you sold. So the $100,000 that you made would be considered capital gain, and you report capital gain. Similar in personal name, when you report the capital gain in the corporation, 50% is also non-taxable. So the 50% that's non-taxable, you need to get it out from the corporation, but you need to tell CIA, hey, I'm taking out the non-taxable portion from the corporation. You don't pay tax in your personal name for the non-taxable 50,000. So you need to file an election called capital dividend election to tell CIA that, hey, you are taking that 50% that's non-taxable from the sale of the property.
Okay, so you're basically just getting what is rightfully yours out of the corporation without
Exactly.
it getting taxed.
But officially making it known to CLA that's what we're doing.
Okay, and so how is that different than the 30% refundable dividend that you were talking about?
So the 30% refundable dividend tax is just refund a tax that you already pay to CLA, or you are about to pay to CLA, but by declaring a taxable dividend. So before we are talking about non-taxable, so it's non-taxable, but now we're talking about taxable.
Okay.
You're declaring a taxable dividend to the shareholder, and then you would be able to trigger the refund. You can do that in the same year, so you lower the tax from 50% to 20%.
Okay, cool. Thank you. There's a question that came up from Karen Zhang. What is the cost to set up a corporation as the beneficial owner, and then the cost to transfer legal title to the corporation later on? So back to the example we were just talking about.
Yeah, so the corporation setup, like I mentioned, if you have to, depending on how you set it up, who you work with to set it up, it could be anywhere from like a few $100s to a few $1,000s, depending on who you work with. Now, to set up the beneficial owner, typically you sign something called a trust agreement. And that trust agreement, depending on the lawyers that you work with, could be a few $100s to a couple $1,000s when you set it up. And typically the bank, the lawyer that closed your property for you would not want to do the trust agreement for you because there's a conflict of interest. So you want to work with a different lawyer.
Do you do the trust agreements as well?
No, I do refer it to a close lawyer that I work with to set up the trust agreement.
Okay, so what Sherry is referring to is it's a clause that's always been in mortgage documents, but just never enforced. And over the past few years, it's starting to be enforced. They ask a very specific question that they expect you to answer. That question is there any third-party interest in this property? Is there any third-party interest in this property? You can argue it two ways. You could argue it that yes, there is, because there's a separate corporation that we're transferring beneficial ownership over to, in which case, because the lawyer has fiduciary duty not only to you, but also has dual agency that they have to, they're also representing the lender. Even though you're paying the lawyer, they represent you and the lender. That's just how it works. And because they're in dual agency, they have a fiduciary duty also to the lender. So if you tell them something like, "Hey, yes, I'm transferring the beneficial ownership over the corporation," they're going to be like, "Oh, okay. Well, I have to say yes on this, and I have to tell the lender, and that might kibosh your deal, right?" So what we're talking about is handling this kind of separately with a different lawyer who doesn't have that fiduciary duty to report this to the lender. Keep it completely separate. Did I sufficiently address that? Does that make sense?
I think so. I'm not the lawyer, so I don't know why they don't set it up. I don't set it up because I can't set it up. But essentially, that trust agreement is just a one-page document to formalize your relationship, your intention that you own the property. You don't personally own the property, as the corporation that own it. And CLA admits that. We've got an audit with that in place.
It's very much like, a trust fund baby turning 18. They get access to their assets, right? That's basically what we're doing here. There was another question. Is it a good idea to open...
Matt?
Yes.
We are just past 9, so why don't we do our wrap-up slides for those that want to maybe head out for the evening?
Thank you, Shelby, for keeping me on track. I'm never on track. All right. Can everyone see my screen? So Sherry, do you mind sticking around while I just wrap this up? Whoever wants to take off can take off, and then if you don't mind sticking around and answer a few more questions, then
sure.
Cool. Do you have to go? Or you?
No.
Good. Okay. All right. So let's do a wrap up. Okay. So we talked about this before. So what's your next step? If you want to learn more about accounting and tax, don't come here. Don't talk to us. Talk to Cherry. But if you want to learn something about real estate, and specifically Toronto real estate, then come talk to us. That's what we're here for. So you can email info@volitionprop.com, but we really encourage you just to use the link that Shelby's going to drop back into the chat again. Yep. Thank you. Number 2 is our upcoming investors mastermind. So next month we are doing, for those lucky people who joined early, I gave them a little preview. Next month we're doing something called Toronto's next hottest neighborhood. Why and how to invest there. This is groundbreaking stuff. No one's ever done this before. We are breaking new ground here. We are trailblazers. We are looking 5 or 10 years ahead to see where to invest in Toronto and why. So we're going to be using established fundamentals and frameworks to analyze this. So, this isn't us just throwing a dart at a map and hoping for the best. This is us actually doing the research, doing the analysis, and more importantly, doing the synthesis into a viable business model that will work in these new hottest neighborhoods that we've actually identified. So that is June 23rd, and Shelby is going to drop the link in the chat for you to go and RSVP so you don't miss it. And who can do it? You can do it. We think you can do it. We would be honored to be part of your journey to help. What's this? Oh, it's a poll. We would be honored to be part of your journey and to assist you along the way. That is what we do. That's our mission in life. So that's what we're here for. And we're going to do a poll. So how much value did this meetup provide on a scale of 1 to 10? So I'm assuming
1 to 5.
1 to 5. I'm assuming that most people are answering 5 in relation to the latter half of today's meetup. But I'm gonna say that it also applied to the first half. So anyway, thank you. Shelby, are we announcing masterclass or not?
No, not quite yet.
No, so that's why this slide was after the thank you and good night slide.
That's correct.
Okay, so we're not going to announce masterclass. Well, anyway, thank you very much for joining this evening. We're 8 minutes over time, but if you're finding this particularly scintillating and intellectually stimulating, feel free to stick around. Cherry is so graciously going to give us a little more of her time. But if you are done for the evening, thank you for joining and good night. Okay, now we're going to share the results. Not bad. Look at this. If you add 4 and 5, we're at like 90-something%. Pretty good, pretty good. Thank you very much. Okay, let's go back to Cherry now. Sorry, was there any other questions? I can't remember. My chat function's gone.
Yeah, we still have lots of questions, but I would encourage anyone that's still around, if you did want to unmute, we could do that.
Okay, someone unmute and ask your question.
Hi, Sherry. Hi, this is. I just wanted to ask you, what is the difference or the advantage between the tier 2 corporation and tier 3 corporation? 3 or 2 tier and 3 tier?
When you say 2-tier corporation, what do you mean by 2-tier corporation? Like a property management company and real estate holding company?
No, it's like a holding company, and then under the holding company below there, like a 1, 2, 3, like small company, number company holding the properties.
So we typically use holding company for essentially risk segregation. So it's like the way, so there are 2 ways to look at it. One way is that if you plan to grow a lot and you have multiple, if you plan to grow a lot and you have big plans to grow and you know that you're going to buy many properties and you're planning to set up multiple corporations for multiple properties, then we would encourage you to set up a holding company and then a real estate corporation underneath. The reason why we do that is because you will then be able to separate the risk. Now, the way it works is that, like, let's say you finance a property And if you do an upstream dividend to the holding company, it's immediately the cash is off the balance sheet of the real estate holding company. And so you're essentially using holding company and as an extra layer of risk segregation for any appreciation or refinancing that you have. And there is no tax implication. You're just there's no tax that you need to pay for the holding company.
I see. Thank you very much.
Hi, there's one question in the chat that I think is important. Will the PowerPoint be available?
Yes.
Yeah.
Yes, we'll share that. Cherry, is yours also available?
I will see if I can cut out my picture there. There's no makeup, so I don't feel comfortable, but I will cut out that picture and then share that with you.
Thanks.
Okay, good stuff.
Hey, can I ask a question, please?
Yes, please go ahead.
This is Justin. By the way, I just had the initial consultation with Anthony this afternoon.
Oh.
So by the way, I asked a bunch of questions in terms of being incorporated. But that's why I'm going to ask another question that I missed this afternoon, but it's not that relevant, with being incorporated. So my question is that the question involves non-residence tax and flipping. So my current accountant told me that, so basically the situation is that my parents they bought a condo in downtown Toronto 5-6 years ago. So that was before the foreign tax buyer policy. And I'm thinking to remove my name and leave their name solely on the title. The incentive from me is to, try to save my mortgage capacity, to trying to improve my portfolio. But in terms of the tax, my understanding is that it will be, first of all, there will be 25% withhold. And after that, essentially, it's going to be the same tax rate applied on my parents as non-residents, because they do not have any other income in Canada. And in that way, we can just we can calculate it as capital gain for about, 4,000 as their annual income. But my accountant told me that will be flipping. If you close it and sell it within 2 years, that's considered flipping. And essentially you pay much more than that. So, I mean, if myself as a, tax resident in this case, how different is that comparing, just two different scenarios?
So flipping versus capital gain long-term buy and hold, it's very different. The CLA in recent years have taken flipping versus what's not considered flipping. So if you close before closing, you sell the interest in the pre-construction home before closing, chances are they're going to go after you and call that assignment sale. And assignment sale is also subject to HST as well. It gets more complicated if it is assignment sale. Now, if you close shortly after you close from the builder, you resell it shortly after you close from the builder, you make less money. And if you close within 1 year, CLA in recent years have taken a very aggressive stand that this will be considered a flip. So they will call you and say, hey, no, this is wrong. It's considered a flip. Now, but the reality is that there were court cases that has gone to Tax Court of Canada, basically argue otherwise. It should be capital gain. Now, just to correct your understanding on the non-residence tax is subject to 25% withholding on the net amount if you file an election. It's not based on the marginal tax rate. 25% withholding on capital gain is also not based on the marginal tax rate. There's 25% and the provincial portion. It's one flat rate, just so we're clear on it.
So thanks. If I'm putting myself on the title, will that be considered as flipping as well? If I sell it after closing within 1 year, will that be also considered flipping?
It has nothing to do with ownership. It has more to do with the duration and how often you do the deals. There are 6-7 criteria that's considered flipping. So if you hop over to my website, which you are probably on my list already, there is a free report on flips, how to determine whether you're flipping or not.
Okay, so only the time duration matters in this case.
Okay, I have a question, Sherry. Can I ask?
Yep, go ahead.
So when you talk about 30% dividend tax rebate, is this for a corporation or for a person?
Corporation. It's refundable tax to the corporation.
Mm-hmm. All right. Okay, thank you.
Hi. Yeah, I had a question. Go ahead.
Sorry, I heard two people. So I think I heard the woman speak before the gentleman. So
okay,
go ahead.
Hi. Hi, Cherry. Thanks for the presentation. It was awesome. And thank you for Volition. They were awesome too. The question I have is about the property manager. That's the one I posted the question. Do I have to manage several properties other than my own to be able to charge for my own properties as a property manager?
No, but it helps with your case. So you're not just in front of the court, but you don't have to. You, as long as you have like the management fee signed, there is also the management agreement signed. There is constant cash flow between the two companies to offset the invoice, and you're operating your property management as if it is a standalone business. You don't have to.
Okay, thank you. Because I was told that in CRA's eyes, it's almost like you're trying to save taxes from one corporation to benefit for the other one. And it would be better, like you said, to manage other properties to make the case stronger.
Yes, for sure. It will make it stronger, but it's not a requirement per se.
Okay, great. Thank you.
Mm-hmm.
Thanks. The gentleman.
Thank you. Quick question there. You guys talked about the mortgage you guys had where it didn't show up on your personal credit report. It was all under the corporation. So is there a name for that kind of mortgage? You mentioned you got that with Meridian, and Matt, you said CIBC gave you something like that. So where would I begin looking into this if I talk to the bank or the mortgage broker? What would I ask for? Thanks.
I will talk first because I actually went to Meridian and I said I don't want it to show up on my personal credit report. It doesn't show up on the credit report. It still shows up as a guarantee. So there's still something, but it's not a mortgage lien against your personal report. Now, the only thing that you would do is that you would go to the bank and essentially say, hey, like I want a mortgage directly inside a corporation. And I want to buy a property inside a corporation. That's as far as you need to do. Like you need to go. I don't know if Matthew has a different opinion.
No, yeah, that's basically it. And you might have more success. Part of the problem working directly with lenders, not that working with lenders is not a great option, but if you don't know where to start, you might be better served starting with a mortgage broker. And a mortgage broker might have access to, certainly there are certain lenders that don't work through the mortgage broker channels, and those ones you have to go directly to. But for all intents and purposes, that's a better starting point because they will know across all lenders or most lenders. And then if you're working with a good mortgage broker, some really good mortgage brokers who truly have your best interests at heart will even say, hey, you know what, if this is what you're looking for, I can't do it for you because they don't, this particular lender doesn't work through broker channels, but here I have a contact, go directly to the lender and he'll take good care of you, right? So that's the importance of having a good team and not just going with, Uncle Joe, the realtor, or cousin Sally, the mortgage broker, or mortgage agent at XYZ lender. It's really, when you're in this real estate game, you have to have an excellent team. No ifs, ands, or buts. So I think starting with a mortgage broker and telling them what your intent is and what your strategy is and what your goals are, that would be a good starting point for you.
Great, thank you so much.
No problem, no problem. I'd like to say that I approached CIBC because I knew about this. I didn't. I knew that they had a DCR lending program, many years ago. It was very famous. Tons of investors use the DCR lending to grow their portfolios massively. For whatever reason, I came across someone who said, hey, you know what, you have, actually, I'd want you to put this in a corporation. And I said, okay, sounds good. Like I was already planning to put it in a corporation. And for whatever reason, it helped with the underwriting and helped with, and then the end result was I had mortgages that had the corporation's name on it. So I didn't go out hunting for it. It actually found me. Yeah. So anyway, for the lending front, I think you should start with the mortgage broker though. I don't think CIBC's, or actually I know CIBC's DCR lending program is not as robust as it was several years ago. Although I have heard through conversations through a private banker at CIBC that they're starting to open it up again. So who knows? Any other questions? Okay, I got one quick one for you, Cherry, before you sign off. Corporate structures now. So a pretty typical corporate structure that you alluded to it before. We call it something different, but basically parent co at the top, and then real co that holds real estate, and then opco, like an operating company with active business income. The three corporations. Is that something, you said, this was popular way back when. I also know that things have changed with Justin Trudeau, Liberal governments, and I won't get Mike Mecca started on this. He could talk your ear off for a very long time about this. I don't know if he's still here, but basically with the changes that the Trudeau government made, now we're starting to think about family trusts. Is that something that you've been talking about with your clients?
Yeah, so we do talk about and we do set up quite a few family trusts, but we tend not to overdo it because family trust has about 21 years life. So essentially, at the end of 21 years, you have to distribute whatever that's inside the trust to the beneficiaries. You have to wind it out. So that's the biggest challenge. If you're young, 21 years from now, the chances are you probably still don't want to give away everything to your kids at that point. And so then it kind of defeats the purpose of setting up the family trust so early. So we recommend that at least you get to the age of 40 or 45 before you consider setting up a family trust.
Okay. And how do family trusts work in conjunction with corporations, if at all?
So family trust is just a trust.
Sorry,
right?
we're losing.
So it's
we're
a
losing
trust
you, Terry.
that if the family trust. Oh, my internet is telling me that I'm late. Can you still hear me?
Yeah, I can now.
Okay. So so typically the family trust would own shares of the operating company, and the family trust can also have a holding company as a beneficiary.
Okay,
Can you
so
still hear me?
Yep.
It says my internet is stable.
Yeah.
Let me just turn this off and see.
Yeah, that's a good idea. Good idea.
Okay, so I have so basically you can have the beneficiaries with, then it gives maximum flexibility in terms of distributing income and giving it to multiple people.
Okay, but it's not something that you're very much actively doing with a lot of your clients right now. But is it part of the planning process, or how are you working with family trusts or considering them right now? Or maybe the answer is you're not even, it's not a very popular option. Don't need to worry about it at this point.
With family, like with our clientele, a lot of them are pure real estate investors. We don't necessarily apply the family trust to pure real estate investors. But family trusts are really popular for people who have, operating company. So if you have an operating company that actually earn business income, that's when we would apply, when we would consider incorporating family trust into the structure.
Okay. Okay, that's interesting. And how does the changes with the Liberal government and Justin Trudeau, how did that change the effectiveness of corporations, so that, basically where even the conversation about family trusts even entered the conversation? What is it about what the Liberals changed about the taxation that even led to this conversation?
Well, one thing is that if you earn income from a related company and you declare the income out as dividend, it could be considered something called TOSI dividend. So if it is considered TOSI dividend, meaning it's taxed on split income dividend, and if you don't have it structured properly, it could be taxed at the highest marginal tax rate, which is 46% in Ontario dividend. And so if you earn, especially if you earn income from your related party, so in the whole co situation, you earn income from the related party, meaning you earn income from your subsidiary and it's income from related party, and therefore it could trigger the income distributed to the owner as related party. But in a lot of our client situation, the owners are truly the one that's working in the business. And our counter to it is that the owner is actually working in the business and truly earn that income. So there is one way around, there's an off ramp essentially. Now in Justin Trudeau's situation, he brought in all these, essentially stop us from declaring dividend to lower income family members who are still in school. That's the biggest thing. All these university kids can no longer fund their education by having the doctors and dentists declaring dividend, doctors and dentists, dad and mom declaring dividend to fund their school. Now, can they still earn dividend? Can they still earn some income from the corporation? Yes, they could. You just do it a different way, essentially, or you wait until they are older than 25 and structure your corporation accordingly to make sure that they own at least 10% shares to qualify to declare dividend to them in future years. So it gets a little bit more technical. It is still doable. It's just that it gets more complicated. You have to jump through a few more hoops for the income splitting.
Very good. Very good. Yes. Yeah. So basically, like what I was getting at was that Justin Trudeau changed some rules that made income splitting harder. That was basically the crux of it. So thanks for that explanation. Okay, we are now, I think we're pretty much at time. Thank you so much for spending this time with our meetup participants and sharing your knowledge and expertise. It was such a pleasure. You're definitely an authority in this realm. So thank you so much. I think that's it. So I'll let you head off. I know you have a new home with young kids that you need to get back to, and a beaver that you need to to go hunt down. And but again, thank you so much, and we really appreciate you taking the time, Sherry.
Thank you so much for having me. Have a great night, guys.
Yeah, you too.
Thank you.
Thank you. Bye.
Well, thanks everyone. I saw one question. I wanted to let Sherry go. I know she has young kids and family to get back to. I too have young kids and family to get back to, but I will answer this one last question. Is it okay to put short-term flips in the same corporation as long-term buy and holds? No, it is not okay. That's your answer. Do not do that at all, ever. I won't get into all the reasons, but you don't want them in the same corp because you don't want them taxed at the same tax rates. You want the preferential tax treatment by putting flips into a separate corporation. Hopefully that's to answer your question quickly. Okay, I don't see any other questions.
Matt,
yes.
Can I ask you a question?
Sure.
Okay, when you were saying about when you buy a property in your name, interest for your corp, so when you do any kind of contract or listing agreement or things like that, do you do it still like in your name or in the corp's name?
So listing agreements, so need to have legal name down on the listing agreement. So it is the legal owner who has to do the listing agreements. For leases and rents get paid to my corp.
Okay.
Okay, so because the corp is the one who has to file the tax returns and everything, right?
I see. Thank you.
No problem. Okay, I'm going to answer this last one and I'm going to go. What is the tax rate you pay on rental income for a property in a corporation? Passive income gets taxed at the highest possible tax rate, which is 50%. So I know that's counterintuitive. Everyone's like, oh, why would you put, you don't always want to put rental properties on a corp. It depends on your situation, right? Like if you are, what's the situation? So for example, if you don't get taxed at the highest possible tax rate, then don't put your, if you've got rental income, let's just say that you purchase a property and it is completely, you don't intend on selling it. You're not going to trigger any capital gains. You only want to live off the rental income and, you know, it works within your personal tax brackets. Maybe you want to hold that personally because on the personal side, you've got the graduated tax rates, but on the corporation side, if it's passive, if it's a corporation that's deemed with passive income, like a buy and hold, the rental income is taxed at the highest possible tax rate. But again, it depends on the situation. Are you depreciating the building, right? So depreciating the building means, okay, well, you have a certain economic life for the building that CRA deems that 25 years, and they allow you to depreciate the building down to 0 over the course of 25 years, which means you can depreciate 4% every year, right? So if you've got positive rental income, positive net operating income, so rents minus expenses, and you've got taxable rental income, maybe you want to depreciate the building to bring your taxable rental income down to 0, right? So anyway, all to say, really depends on your situation, really depends on what you're trying to achieve. But to answer your specific question, it's at the highest possible tax rate, which is like 50% in a corporation if you're just talking about the rental income. But we should be smarter than that. We shouldn't pay tax on the rental income, at least not during the early years where you can also have the opportunity to depreciate the building, the early years where you still have a big mortgage, stuff like that. So you should, done properly, you should pay tax on your rental income, either on the personal side or the corporation side. So hopefully that answers it quickly in a nutshell. Okay, I'm going to sign off. Hopefully you guys learned a lot tonight. So thanks for sticking around.
Thank
Toodaloo.
you.
Bye.
Night.